This is the Financially Simple Podcast, the show dedicated to destroying the complexities of money for today's small business owner. The content in the show is for informational purposes only. This show is not investment advice. Instead, seek help from a competent financial advisor or conduct your own due diligence. Justin Goodbread, CFP, is an investment advisor representative of Heritage Investors, a registered investment advisor only conducting business in states where it is properly registered or is excluded or exempted from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Here's your host, pizza-loving, certified financial planner, Justin Goodbread.
And welcome back to the Financially Simple Podcast. I'm your host, Justin Goodbread. Today, we're going to continue with our deep dive into the area of risk management for us business owners. Now, remember, we're talking about personal finances for business owners. So I'm trying to apply a business owner spin, if you will, to every strategy that we're talking about. Now, we talked about car insurance and homeowners insurance and umbrella policies. Today, we're going to shift a little bit and deal with more personal coverages on insurance. Then we'll jump into legal documents eventually. But for right now, let's focus on our insurance. Let's wrap up all these insurances that we really need to deal with as business owners. I've titled today's topic, Life Insurance 101 for Business Owners. And at this point, you're like, seriously, Justin, life insurance? Hey, hold on a second. Life insurance is one of those things that, in my opinion, every business owner needs. And I'm going to try to persuade you on that today. It's also one of those areas, whenever I bring a client on, that's often one of the lowest hanging fruits that we need to shore up to help the client. I've had the opportunity to deliver many life insurance checks in my days. The very first one, I'll never forget it, was a gentleman who was in his 70s. He purchased a $3 million coverage for some estate reasons. And before the policy was ever issued, he died of a massive health issue. And his children had no idea how much money he was worth. And it forever changed his kid's life. On the opposite side, I had a dear friend of mine one time who said, Justin, my family needs some life insurance. And I basically, for lack of better words, pawned them off on another agent. I didn't want to deal with it. I was extremely busy with the project. And so I asked another agent to write the policy, as write it, in other words, sell it. That's a term that the insurance industry uses. The agent forgot to take what's called conditional receipt, which basically means the life insurance policy was in good shape. And my friend's family member passed away unexpectedly, leaving a wife and a baby with no insurance coverage. I can't tell you how devastated I was that I moved what I believe was my responsibility to another person whom I trusted, and the other person didn't do their job. So life insurance is huge. I have a client right now who's expected not to live much longer, and life insurance is going to be huge for that client's family, surviving family. So today we're going to just deal with 101 because in next episode, I want to deal with a strategy that most of us will see as business owners in our life. And I want you to be prepared for it. I want you to understand it. So let's deal with Life Insurance 101 today, and I'll make this as entertaining as possible and hopefully get through this quick enough. So here we go. What is life insurance? Life insurance is basically an insurance that pays out a certain amount of money, whatever the death benefit is, whenever you pass away, and it provides the benefit, the death benefit, to your beneficiaries, whoever they may be, whether it's individuals, a charity, or a trust. Life insurance shifts money from you to another party. Basically, it's a contract that you make between yourself and an insurance company, and it's a unilateral contract, meaning that only the insurer makes a legal enforceable promise to pay. Whenever you buy life insurance, you're not saying that I'm going to be required for the rest of my life to pay that premium. No, if you don't pay the premium, you don't have the coverage. But if you pay the premium and something happens, then the beneficiaries will, based on the law, receive the death benefit should it be a covered claim. So for a basic nutshell, what is life insurance? It's an insurance policy that if you die, somebody gets some money. That's the easiest way I can say it. So then you ask the question, do you need life insurance? I'm going to answer that question with a question. Does somebody rely on you financially? Does somebody rely on you financially? If you're a business owner, the answer to that is yes. Unless you're single and a solopreneur and you're running a cash-based business. And you may can say no there. But for the majority of humans that walk this earth, especially business owners that walk this earth, somebody does rely on you financially. At least it could be a customer, a vendor, or employees that rely on you. And perhaps you're married. Perhaps you're married or you have children dependent children. If those are the case, you need life insurance. I'll never forget a client of mine who I spoke with this last week. She called me. I was the second person on her phone that she called when she found out her husband died unexpectedly while he was out of town on business, just died unexpectedly in his hotel room. I'll never forget for the rest of my life that phone call at about 1:30 in the afternoon on a Sunday. Whenever I looked at my phone, this client's calling me at 1:30 in the afternoon on a Sunday. And I answer the phone, hello, how may I help you? And the tremor in her voice when she said, my husband's dead. Tell me that I will be okay. I'll never forget that. Thank God we had done the planning right, and her husband had more than enough life insurance to provide for her needs and her children's needs for the rest of their life. But I'll never forget that as long as I live. So much so that whenever I have a client who hires us to do any type of the business growth planning, and we're going to talk about in the future how that actually works, but whenever we have clients who do business growth planning and they refuse to buy life insurance, we do not work with them. Because if they will not trust or if they will not listen and yield their needs underneath a basic insurance product, then we're not going to be able to work with them in the long term on some other areas. So life insurance to me is huge. Do you need life insurance? I'm going to go out on a limb and say, yes, more than likely you need life insurance. What are the types of life insurance? Well, there's two basic categories. One is called term insurance. Term insurance covers your life for a period of time or a term. So the most common in the United States is what's called a level term. Typically, they're sold in 10-year, 20-year, and 30-year level arrangements. So if you bought a 30-year level term policy, then let's say it's $1 million coverage, that $1 million will remain constant throughout the rest of that term or for 30 years. As long as you pay the premium, it doesn't matter what happens to your health. It doesn't matter what happens to your finances. As long as you pay that premium, if something happened to you during that period of time on that term, your beneficiaries would receive the benefit of that life insurance policy as long as it was a qualifying event, which we'll talk about here in a second. So level term is the most common. Like I said, it's typically sold in 10, 20, 30. Those are the most common term periods. Another term you can do is what's called a decreasing term. Now, you don't see these many times, but basically it starts off with a certain death benefit, and over a period of time, that death benefit gets lower and lower and lower. It's not as common. It is out there. Typically, level term is the most common out there. So decreasing is out there. I just wanted to let you know about it. It's not one that I'd worry about or lose sleep over. In fact, just go ahead and forget about it. Another one is annual renewable term. And I'm seeing a lot more of this type of coverage from insurance agents being sold to business owners. Annual renewable term, in a nutshell, is a policy that every year the premium increases a little bit. You don't have to go out and prove insurability again. Your death benefit doesn't typically increase, although some companies I've seen, they can increase that. But for the most part, your premiums increase the longer you hold it. So every year it renews for a little bit higher price. And honestly, in younger clients, it's one of the cheapest ways you can buy life insurance is an annual renewable term. May not be the best, but it's one of the cheapest ways you can buy it. So the two types of life insurance, one fits into the category of level term or term insurance, and that's level decreasing or annual renewable. The other type of insurance is what's called whole life insurance. And it's a category of coverage. And I use that, or some people may call it permanent life insurance. That's another way I can describe it. So term insurance and permanent insurance. In permanent insurance, what you traditionally have is a life insurance policy that will last you throughout your entire life. It doesn't run out like a 20-year term insurance. If you bought it when you're 40, at age 60, the premiums go astronomically through the roof. It gets crazy expensive, so people just drop it. Whereas a permanent insurance, the premiums will typically be a little bit more expensive in the younger days and traditionally be a little bit less expensive in the older days, just based on inflation and all the different factors. So under permanent insurance, you have a bunch of different types of policies. Perhaps, and I mentioned this earlier, one of the oldest is what's called whole life. Whole life insurance came around many years ago. I'm not going to go into the specific. There's lots of scenarios out there. I'm trying to keep this simple for us, but whole life insurance basically is this. Your death benefit is going to be equal to a cash value at age 100. So if I went out today and bought a $1 million whole life insurance policy, the company is going to set a premium schedule to me, and that premium schedule is going to give the company enough money that they can build a cash value, or basically like an account within that life insurance policy. And the company's desire is that by the time I reach age 100, that I have $1 million worth of cash or cash value within this life insurance policy. If my benefit was $1 million, then that means every year, the older I get at age 100, they want the cash value to equal 100. Why? Well, in a nutshell, they're reducing their risk, because at 100, you're more likely to die than you are statistically at age 30, I'm assuming. I haven't looked at that exact table, but I'm just running the math in my head. So under permanent insurance, whole life is perhaps one of the oldest out there. It has its place. It does have its place. We're going to talk about that in the next coming episodes. But for right now, just knowing the permanent life insurance, there's a product called a whole life policy, and the death benefit is trying to match the cash value at 100. So the premiums are going to be a lot more expensive than they are in term insurance.
You're listening to the Financially Simple Podcast. Show your support by subscribing to this and our other educational business channels at financiallysimple.com.
Now, variable life is a different beast. Basically, the cash value is going to be invested into separate managed accounts, very similar in concept to a mutual fund. So again, they're trying to get the ultimate cash value to equal the death benefit at age 100, because most variable policies are permanent in nature. That's just the broad-based stroke here. There's all sorts of variations. Trust me, I've seen them all just about. But in a nutshell, the cash, instead of sitting on the company's books as an asset, the insurance company is going to take the money that you're putting into this life insurance policy, and they're going to invest it into separate managed accounts or mutual fund-like investments. Not really a mutual fund, but similar to it. Variable life is often sold as a quasi-retirement account. And we're going to talk about that in the next episode in detail. Another permanent life insurance is what's called universal life. And universal life allows for flexible premium payments to be made by the owner in minimum or maximum amounts. So if we understand whole life, that death benefit is supposed to be equal to cash value at age 100, then universal life is going to try and create flexibility. So in the earlier days, oftentimes if you have children or if you're trying to start your business, you may not have enough money to put in the whole life premium amount. So oftentimes they're sold with minimum funding. I see that so many times with business owners. They'll say, well, this is going to be a life insurance that's going to be in place when you actually die. And it's only going to cost you $200 a month. And so they're minimally funding that policy. And then what happens is as you get older, you have to dump in more money than that minimum funded. You actually have to catch up all those premiums that you should have been paying all these years. So universal life is a real popular coverage that's often sold. And in a nutshell, it allows the owner to pay maximum or minimum amounts of premium every year. Now, another one which has resurfaced here in the last little bit is what's called an indexed life insurance. Index life. So the amount of money that we put into the life insurance policy, the portion of it that the whole life company would basically hold in their accounts, in an index life, they're going to take that surplus or that cash value and bench it against the index. They're going to match an index and try to give you the return that's comparable. It's real popular right now. The sales pitch goes something like this. You can put your money in the life insurance policy and the cash value will never decrease and the cash value can only increase. If the markets go up, you make money. If the markets go down, you don't lose any money. That's the basic sales pitch that you may hear. I'm not a proponent of index life. I don't like them. They have their place. They do have their place, but I'm just not a proponent of it for most of our business owners. It's just not. So with that being said, what type of life insurance do you need? Notice the optimal word there is need. I'm going to keep this super simple for us. You need a 20 or a 30-year term insurance. That's all you need. A 20 or a 30-year term insurance. Well, Justin, why one or the other? You know, I used to say that it had to be 20-year term until I just recently redid some coverage on myself. So I have a $3 million now 30-year term policy. Whenever I priced out the $3 million 30-year term, it was just a few cents more than a 20-year term policy. Surprisingly, it was crazy close on the premium amount. So now knowing that I'm 40 years old and my grandfather and my dad have both passed away before 70, that $3 million life insurance policy now will get me to age 70. Hopefully at that point, I don't need any life insurance for my family. So therefore, I'm going to let it lapse. So I bought a 30-year term life insurance. And it really, for my case, it wasn't much more expensive than a 20-year term. But for the most part, for most people, you need a 20 or 30-year term life insurance policy. And I would say the majority of the time, 98, 99, I can't say 100%, a 20-year term policy is all you need. The key is to make sure, though, that the policy is fully convertible the entire length of the term. So here's what happens. We buy a term policy and we're age 20. And we get a 20-year term and now we're age 40. But between age 20 and between age 40, we develop a health issue for whatever reason. And you're no longer eligible to get additional coverage. I've actually seen clients that develop such a large health issue that they had to convert their policy so that their beneficiaries would have life insurance. I had one client pass away that we had to convert it to a permanent policy in order to keep beneficiaries in place. And I have another client that's dealing with this right now. The wife is a business owner. The wife was diagnosed with dementia, early onset dementia, in their late 40s, early 50s. And we had purchased a 20-year term life insurance policy. And based on her diagnosis, she may live past that 20-year time period. So we want to have the ability to change that life insurance policy from a term insurance to a permanent insurance later on, should she live a long time. So what type of insurance do you need? You need a 20 or 30-year term insurance that's fully convertible, that's able to be converted to a permanent insurance all the way the length of the term. That's what type of life insurance you need. So that leaves the last question. How much life insurance do you need? There's a lot of rules out there. Some people will say you need 10 times your income. So if you make $50,000 a year, you need $500,000 of coverage. If you make $100,000, then you need $1 million of coverage. I'm not a big fan of that one. I'm a fan of pay off your debts, leave your survivors in a debt-free position, and have them enough money to live on. That's my position that I believe in. I've dealt with enough death in clients to know that I've yet to have a person say they didn't have enough life insurance. So my belief is you pay off your debts and then have enough for living expenses. So how do you calculate that? Well, if you have $500,000 in debts, you need at least $500,000. And if you spend $50,000 a year, then you may need $1 to $1.2 million on top of it. Well, how do you calculate that, Justin? Well, let's keep it simple. Let's say you had $1 million life insurance policy and you need to spin off $50,000 a year. That's a 5% yield. So if we had $1 million that we invested and made 5% on it, that would give us $50,000 a year. Now, could it grow with income? Well, maybe you need $1 million too, so that we're not taking out all of our dividends every year and we're allowing the proceeds from the life insurance policy to increase year after year after year. So whenever I calculate life insurance amounts that are needed by clients, I believe you should pay off all your debts. I really do. I don't think you want to strap your spouse, your children, your business, your significant other, anybody with your debts. So pay off your debts and then leave enough money to provide the living expenses that your members of your family need. So whenever I have currently $5 million of life insurance, I don't have much debt. I really don't. We have a little bit on our house that I talked about a while back. Not much. Relatively to my net worth, very little. But man, I have a lot of team members who are relying on me. So we have some life insurance that pays the business, that gives the money to the business so that they can hire in another Justin or they can take care of the team. It's my responsibility for me to do that. So I have that. I also have enough money that my wife and my children will be able to go to college, and my wife, Emily, will never have to work again or another day in her life. I believe that's my personal responsibility. Well, Jiminy Christmas, Justin, how much does it cost? Not much. I think less than $1,800 a year, less than $150 a month. And now she has enough life insurance for the rest of my life that if anything ever happens to me, my bride, the girl that I walked down the aisle with, the girl that I said, honey, for better, for worse, rich or poor, for sickness and health, I will be here. The girl that I believe is my responsibility and it's her responsibility for us to take care of the children we've been entrusted with. So how much life insurance do I need? Man, if I did 10X, I couldn't say that. So I believe you ought to have enough to pay your debts plus your living expenses. That's how much you need. And it's going to be based on insurability. Obviously, maybe you're not as healthy as I am, or maybe you've had life events, circumstances different and you're just uninsurable. Well, then you get as much as you can at that point. Perhaps you're dealing with estate issues. That's a whole conversation we'll talk about here before too long. Life insurance comes in as a possibility to help levelize estates. So now you've heard just the basic financially simple scenario for life insurance. So what is it? It's a basic contract between you and an insurance company that gives money upon death. Do you need life insurance? Yes, you need life insurance. What type of life insurance? Stay away from the permanent products for most part. Try to stick with a level 20-year or 30-year term that's fully convertible. Fully convertible. That's the key. You never know what life's going to throw at you. How much you need? You need to be able to pay off all your debts so you don't leave your beneficiary strapped with debts, and enough money in an account to provide for their living expenses. So if you use my simple math of $1 million invested at 5%, it's $50,000, or $1.2 million invested at 5%, it's going to give you $60,000. Maybe only take out 50 and let the other 10,000 a year grow. You can provide a lifetime stream of income for those whom you love. Guys, with that, I'm going to tell you, life is hard. Life is good, and life can be frustrating. Money doesn't have to be. Let's continue to make our lives at least financially simple. Hey, y'all go out and make it a great day.
You've been listening to the Financially Simple Podcast. For more business and personal financial help and information, head over to financiallysimple.com today.